Okay, fantastic. Hello, everyone. First of all, thank you for the time tonight, this afternoon, this morning, wherever you are in the world. I certainly appreciate the chance to talk to you about options. I think I'm very excited to be starting this course. This has been a long time in the making. So most of you probably know the technical analysis course. And if you don't know who I am, I'm not going to give you a big bio here, but you should follow me on Twitter at Adam H. Grimes. And you also should go to marketlifetrading.com and check out the trading course. There's a 30-hour technical trading course that will really help you develop your own trading style as a technical trader. We'll talk a little bit more about that at the end, but that course has been done for many, many years, since about 2013. And I always had the idea of doing other courses to go with it. And this topic was one of the main topics that I'd always wanted to do, but it has to be done right. And I'm excited, I think, to finally know how to present it to you. So with no further ado, let's jump in and let's talk about this task of learning options. So what we're going to do today is really pretty high level, but it's important stuff. And I know that a lot of people, you come to a presentation like this and you might think, oh, I already know what a call is. I already know Black-Scholes. I know all this stuff. I don't need to start with basics, but I think it's worth spending some time here at the beginning looking at these basics, because if anything is just a little bit confused or turned around the wrong way, then it's just going to mess us up more later. It's very difficult to understand, say, complex options positions when you might not understand how a single option is priced. So that's kind of the big picture of what we're going to build up. Some general thoughts about learning options. There's no magic to options. I remember when I started learning options years and years ago, I thought, wow, this is such a complex topic. It's rocket science. Like, I'll never be able to understand it. And I also thought that people who traded options were like really the smartest of the smartest people on the planet. And I don't know, maybe that's true, but the fact is that options are really just another trading tool. It's not going to solve all your trading problems, but it's also not as complex as you might think. And that's going to be one of the recurring themes, which I hope to do mostly behind the scenes, but I'm really looking for that right degree of depth and complexity. Like, we need to talk about some kind of far out there topics. We need to spend some time on some things that might seem to be a little bit academic. I promise you they're not, because there are plenty of like crazy academic things that we don't need to spend time on. So I'm really focusing on not getting as lost in complexity. And here is what, if I want one thing for you, I want you to be able to come away from this course with what I've said, what I just circled on the screen, an intuitive understanding. So I want you to be able to think, okay, I have this position, and what happens if fill in the blank happens? What happens if the stock does this? What happens if the market does this? And you can even think in a macro sense, what if I have all these option positions on and then the Fed changes rates, or something happens like that. So it's one thing to know the math, but I want to get us beyond that. And I want to get you to think about it like this, with the intuition. I want you to be able to think like an old experienced options trader would. That's where we're really going. So just kind of to back out of options, for many of you, this is going to be a reminder if you already know my work, but if you don't, these are things that I believe very, very strongly are true. And that's based on my practical experience trading every market, every time frame for a couple decades, based on a lot of my academic work, a lot of my research, a lot of quantitative work. I'm almost 100% positive what I'm going to tell you here is true. And these things there's no free lunch. And what that means is there's no way to make money in the market that does not involve risk. Why? Because markets are competitive and other traders are not stupid. If you're looking at a trade and you're thinking, gosh, this looks so easy, what stupid person is going to take the other side of my trade? Well, you should have a warning light that goes off that says, wait a minute, the person on the other side of my trade is probably not stupid. Why not? Because the market destroys stupid traders very quickly, very efficiently. And anybody who is a quote stupid trader is pretty quickly eliminated. They're not a significant influence in the market. Markets are usually close to informationally efficient. What it just means is like new things happen, new things come into the market, and the market figures out what the right price is. So I don't think you can like read the news and figure stuff out. It's very, very hard to get in front of the market because the market is usually thinking several steps ahead. However, and this is not just academic. This is how we make money. Humans make decisions. Well, that's what moves prices, right? People making decisions. People make decisions based on both rational analysis and emotional context. What this means is that even those traders who I just told you are not stupid are sometimes stupid. Sometimes we overreact. Markets do reach emotional extremes, and you understand that this is part of the market environment. Markets are usually highly random. A lot of people disagree with that, but that's very, very important for options. The way the market moves from one price to another, or even what price it goes to, is usually not as predictable as we wish. I say always not as predictable. It's sometimes completely unpredictable. And here's the last part, which we're really going to get into today. If you want to make money in the market, you must have an edge. And that's obviously another presentation. So here's what we're going to do today. We're going to talk a little bit about the advantages and disadvantages of options, which basically why you should be trading options and what could go wrong trading options. Then we're going to do just a little bit, just like 2 minutes of options 101. What is an option? Because this will let us think into the two broad styles of trading, which I would broadly call directional, non-directional. You might think credit or debit's another way people think about it. And then we'll talk about where the rest of the course is going, where we're really going to dig into the meat here. So advantages of options. Why would you want to trade options? Well, I have a long list here on the page, and every one of these things is true. But I think if I had to get away from the page, if you just stopped me on the street and said, hey, why should I be trading options? I would say, first of all, it depends what kind of trader you are. And if you're a trader, particularly with a smaller account, there are huge advantages to trading options. One of them is leverage, which is marked here with a question mark. Why? Because you can get in trouble that way too. I think back to my early experiences with futures when I did not understand leverage or the kinds of risk I was taking into account. So you have to understand it. That's also one of the recurring themes of learning to trade is you got to understand what you're doing. Options really let you dial in the risk that you want to take and the way you want to take. And I think the bottom line answer to why should I be trading options is because you can do things with options that you can't do in any other way. And I know almost all of you listening to this presentation, this is not your first rodeo. Some of you may very well be very experienced. You've certainly watched other educational things. So you know that people will talk about things like selling time. And some of this is really, maybe, while it's true, it's a little disingenuous in the way it's presented. And we'll talk about that a little bit. But you can make money when something moves. You can make money. You can be wrong and still make money on the trade. And guess what? What do you think the other side of that is? You can be absolutely right and lose money on the trade if you don't understand everything you're doing. One of the other reasons that I think is several of the traders who trained me said this all along, and it took me a long time to understand it. But if you learn to think in options, thinking in options is not actually a thing, but if you learn to think about structuring trades in terms of options, and you think about payoffs, and you think about probabilities, you think about magnitudes, it forces you to think about the trading problem in a way that takes you immediately to what having an edge is. It's one thing you can be like I was at first. You can have a chart and you can look at a pattern. You can think you found a magical pattern. It's going to tell you where the market's going to go. That's a very elementary, basic way of thinking about trading. And it doesn't really work quite like that once you've been trading a while. But if you're forced to think in options and you're forced to think right away about the range of probable outcomes, possible versus probable, and how might we get to certain prices, and that can give you a much deeper insight into the whole trading problem. So what can go wrong with options? Well, admittedly, they can be a little bit complex. There are definitely some tricks. So, I've said some gotchas. For instance, some people are surprised if you're the first time you pull up an option to trade, you might find the spread is huge. It's not impossible by any means to find a option where the bid is $2 and the offer is $7. What are you going to do with that? Think about trying to day trade something like that. You can't, it would be suicidal. And there are many, many other ways to get hurt with options if you don't understand them. So you do need to be aware of those. As I said, liquidity can definitely be an issue. And one way we can overcome that, I'll tell you the secret right now. One way you can overcome that is just don't trade really thin options. You pick, there are so many things out there to trade, so many stocks, so many futures, that you almost always can do what you want to do in a market where there's enough liquidity to manage your trade and to take your trade. And there are certainly other ways you can deal with the issue, but you definitely need to be aware of liquidity in a way that you probably don't have to be aware of if you're just trading outright, stocks or futures. Sometimes the risk in risk in options can be hard to understand. It is, for instance, relatively easy, and we'll talk a little bit today about, it's relatively easy to understand that you could set up structures where you could lose an unlimited amount of money in either direction, more or less unlimited. And I guess actually here's a little footnote detour. I will say unlimited infinite risk, when in fact sometimes it's not unlimited, but from a practical perspective it is. An example, if I buy a stock at $100 and that stock goes to zero, that is effectively an unlimited open loss for me. Yes, it is bounded by zero, but in the range of possible outcomes, that's still, to me, pretty close to an unlimited loss. So it's very easy to set up structures like that, but there are even other ways that you might, for instance, a very common thing if you traded options. Have you ever seen something that's moving and you're very excited to get into it, and so you run and you buy an option? Let's say you think it's going up, so you buy a call and it continues to go up and you lose money. If that doesn't happen to you, either you had a really good options education when you started, or you haven't been trading long enough, because that's a very, very common outcome. And when you understand how these things are priced and how they move, it starts to make a lot of sense. At first, it's just very frustrating. And so if we don't understand those risks, if we don't fully understand options, that's why we're spending so much time here in the first few modules on these basics. You're going to end up taking risks that you don't know about and risks that you don't want. And you get away with that for a while, but eventually it's going to kill you. One of the other disadvantages of options is that as soon as you buy an option, you own a decaying asset. Now, a lot of people turn that on its head and say, okay, well, you should just sell options because that becomes an advantage. I would actually argue it's not quite the disadvantage we think it is, and it's also not quite the advantage we think it is for the seller. We're going to talk a lot more about that. Also be aware that most people who are teaching you how to trade options, it's not really pure education. Maybe more than almost any other segment of education. They want you to do something. They're selling you something. They want you to trade with their brokerage, trade a specific way, or maybe they just oversimplify. It's really easy to dumb options down to the point where I can tell you everything that you might think you need to know in options in about half an hour. And then you go away and you're going to lose money because some of these gotchas are going to get you eventually. So we just have to do things right here from the beginning, and that's what we're working on. So some of this is review already, but just be aware that in addition to being able to do things you can't do any other way, some of the things that you're already doing, you probably can do in a better way with options. For instance, I'm a directional trader, and you're going to see that I'm going to give you tools. I'm going to give you ways to trade options, however you want to trade options, but you're definitely, absolutely going to see my emphasis on directional trading, my emphasis on swing trading coming back into this over and over. So the lens through which I see all market action. And there are ways that I can trade with options that I can't trade with the outright. There are possibilities for setting up trades and really attractive risk reward opportunities that you simply can't do any other way. With a smaller account, you can trade like a big account. And no, I don't mean that you can open a $5,000 account and make $1 million by the end of the year. Yeah, you can do that. Buy lottery tickets. Yes, there's definitely some way to do that with a really small probability. You can effectively do the same thing with options, but then you're still gambling. But what I mean is, if you have a small account, it can be difficult to have many positions. It can be difficult sometimes to have more than 2 positions in a stock account. But if you're trading options, you can have positions and be managing positions in many different stocks at the same time. That's what I mean by trade like a bigger account. And you can tie that in with leverage and you get some pretty impressive returns. Bigger accounts, you can control your risk. Retirement accounts, there are things that you can do, and we'll definitely talk about this, about hedging, about limiting your risk. That's also going to be a theme of the course. It's one of the things I do in my personal retirement management. I hedge rarely, but I pick the spots when I hedge, and when I do so in very simple ways. And I don't always hedge, but when I hedge, I use options. Also, it's not that hard to learn this stuff, really. It's not. So here's your options 101, which you can go read anywhere on the internet. Yes. So what is an option? It's a contract. And if you think about it, back away from finance for a minute and think about an option in general, it just gives you, if you buy an option, you have the choice to make a decision in the future. That's the way to think about it. Maybe you see a car on Craigslist and you go to the buyer and you say, look, I'm not ready to buy it today, but let me give you a few $100s and I'll, give me 2 weeks, I'll decide if I want to buy the car. So you bought an option, and yeah, it's very common in real estate. That's all you're doing with an option. You pay premium, and that's an important piece. You pay for the right to make a decision to, if you buy a call, to buy the stock, or if you buy a put, to sell the stock. So that's the difference. And usually, kind of in your mental map, you can think, okay, if I'm buying a call, I'm probably thinking about being long the stock. If I buy a put, yes, you're selling the stock, but I'm probably thinking about being short the stock. Now, it's not necessarily true because you could be spreading something, but that's several modules down the road. So just 101 here, right? Also, there is, with every option, a specific price. This is called the strike price. And there is a time limit to, with some options, there's a single time that you can do it. And with other options, there's a range of time. So that's basically all an option is. Very simple example. Let's say we have stock ABC, which is actually a ticker, right? Let's say you have a $100 call option that expires on the last day of December. No option will expire on the last day of December, and you pay $1 for that call option. This is a purely theoretical example. So the strike price, the price at which you will be able to buy the stock, is $100. The type of options, call option, the underline, and these are words you're going to hear me use casually, so I just want to make sure that we're on the same page. Theoretically, I'll talk about the underline. That means what is an option on. That could be a stock, could be currency, could be futures. Expiration date, and then the premium paid. I think this all makes sense. So what this would let you do, just think in the future, you have the right to buy the stock at $100. Now, you have the right, but you don't have to do it. So what if here on 12/31, the stock is at $120? Well, what you could effectively do is exercise this option. You buy the stock at $100, and then you own it at $120. You have the instant profit on the stock. On the other hand, what if the stock on the day of expiration is $80? Well, why would you buy it at 100? You'd immediately realize a $20 loss. So you just wouldn't do anything. That's where the optionality, where you have the ability to make the choice to buy or sell in the future, and that's what gives the option its value. So that is, in fact, the key question. What is that option worth? And we're going to spend the entire next module talking about that question, because it's not an easy question to answer. What would you pay for the option on stock ABC? Well, you'd have to start asking a lot of questions, right? One of the good places to start is by thinking about what will the option be worth at expiration, which is just what we were doing. You can think about where the stock might be, and then you can think about what the option would be relative to where the stock is. And then you kind of got to work backwards, right? And think, how likely is the stock to be at 100, 1,000, $10,000, right? Once you can attach how likely those outcomes are, then you can start to think about what the option might be worth. That's kind of how we think about it. Do be aware that, and for those of you who've had some basic options education, that's kind of how people think about positions, right? You think about buying the option and you think about what's going to happen at expiration. Just be aware that that's not enough. It's not enough to understand that I buy that $100 call. $100 call means it's a call with a $100 strike price. And if the stock is above $100 at expiration, I make money. Done. The problem is that a lot of things can happen between now and expiration. And that's where much of the magic and detail of trading options happens. That's where it lives. What would be the practical considerations here? Well, first of all, how do I buy that option? How big is the spread? What if we look at that $1 option and we find that it's bid at 50 cents, offered at 150, or maybe it's a very tight spread on the other hand? What costs are associated? And by the way, these types of questions, cost, financing, margin, we're not going to cover that in the course, because that, for two reasons. First of all, it's very specific to your specific situation, which I don't know. I don't know how much money you have. I don't know where you are in the world. I don't know your broker. But also, it's your broker's job to answer these questions for you. So, and they're very good at answering this question. So you need to make sure that you get the options trading information from your broker, and that you review it and understand it and ask questions. They're more than happy to make sure you understand the costs, and in particular, margin could be an issue. Also, the mechanics of expiration and exercise. And this is not really quite the important thing it would seem to be, because what I just did on that previous slide, let me go back to the previous slide, where talking about, okay, at expiration, what decision would I make? That's a theoretical thing that does in fact drive the value of the option, but many options traders, I might even say most options traders, you never deal with that. You never have to deal with that, because you're selling or covering the option before expiration rather than carrying it into expiration. But you still need to know, like for instance, I saw a Facebook post from, and some of you will understand this right away, the guy was upset that the post said something like, so I ended up with this worthless in the money option at expiration, and my broker exercised it. Of course, he didn't have the money, so he got a margin call and he was upset. But it was not a worthless option because it was in the money, and the broker auto exercised, which is standard. Those are things that you need to know, but also they will change over time. So if you're looking at this course years and years in the future, knock on wood that it will be evergreen and it will still be out there, the rules and the way things like that happen may be a little bit different. So just make sure you understand the mechanics of trading options very clearly, and your broker is the best resource for that. So thinking about buying that option, let's turn it around for a minute, because where you didn't just go to the option vending machine, right? That's not the way it works. You didn't go to the option vending machine and you end up with this magical option. Somebody sold you that option. And the other language that we will use, I don't know, I'll probably say write as much as sell, but the person who sells you the option writes the option. That's the other way to say it. Think about the person that sold you that option. So what rights do they have? Well, you, the buyer, have the right basically to make them do something. So they ended up with obligation and not really a lot of rights. What profit potential do they have? You paid them money. The guy put that money in his pocket, or the lady put that money in her pocket, and that's their profit potential. What risk do they have? Well, all of your profit potential becomes their risk. So it's a little bit weird if you think about it, right? But now go back to where we started at the beginning of the course. There's no free lunch. Markets are very competitive, and there aren't stupid traders. So the chances are, one time in a rare case, you will sometimes get a happy fill. Somebody on the other side will have made a mistake, and you'll feel very good about that. It certainly happened a number of times to me where I think I'm happy to provide liquidity for your mistake, but you can't rely on it. You're not going to build a career on it. It doesn't really happen that much. So that person who wrote you that option, who sold you that option, probably knew what they were doing, and they probably sold it to you at a fair price. That needs to be your thinking, that wait a minute, there's probably no free lunch, things are pretty well balanced here, so what's actually going on? Okay, so there are a few topics that we're going to kind of go a little bit off the beaten path, but I will warn you where you don't really need to study and absorb the information. I just want you to know that there are basically two flavors of options, and the vanilla options are the only one we care about. And we don't actually care about this difference between what we call European and American options. And just to be clear, that's a label. I actually don't think I know the history of where those labels came from. I'm sure there's some interesting story, but the difference is that an American option can be exercised early. And most stock options, I believe all stock options, as far as I know, are American options in the US. European options can only be exercised at expiration. Does that matter? We'll come back to that in a minute. So those are vanilla options. Non-vanilla, there are so many different possibilities for non-vanilla options, and you probably will never have to deal with them. Depending on your arrangement, sometimes the floor trader, the floor can come to you basically and say, hey, we have this great deal where basically you can do an option for anything, right? You and I could agree to make a bet based on what the weather is tomorrow, and I'll pay you money if something happens in the stock market based on the weather. Like, we could come up with some kind of complex, weird structure, but some of the possibilities are almost that weird. But some of the non-vanilla options that you will see, so there are binary options, and what these are, they're all or nothing payouts. I will also tell you, and if this makes anybody angry, just go away. I don't care. Absolutely, the biggest scams in the retail trading world live in two places. Live in Forex, and I do think you should consider, probably should trade Forex, but just be aware there are a lot of Forex scams, and binary options. Absolutely, without a second thought, anybody who messages me through any social media and wants to talk about binary options, I just block them. Like, it's absolutely the biggest scam. And we don't really need to talk much more about that, but there's some of these other strange kinds of options. One of the most interesting are barrier options, where let's say that stock is at $100 and I buy that $100 call, but let's say it's a knock-in option. So, and say it has a knock-in at $90. So what does that mean? If I buy that option at $100 and the stock goes straight up to $500, I don't make any money unless it goes down and touches that first barrier, at which case the option becomes live. And there also could be knockout options. So maybe I buy that call at $100, and if the stock price goes down to $90, the option disappears. And these things are quite difficult to value. We're pretty far off the beaten path. You probably will never care about those. Just be aware that they do exist. And there might be some point in your trading career when you want to explore these, but I would say almost certainly not. So it's not as bad as it seems. You're going to trade listed, which means exchange traded vanilla options. As I said, stock options are American style. Most futures options, but there are some pretty big exceptions. Where do you find this information? The exchanges are very, very good with educational information. As far as like product description, you just go to the exchanges, and anything you want to trade, they'll have product, the contract specifications. Index options are another, and there's also the possibility, which we don't really need to get into, but there are some things that are settled rather than, for instance, with the S&P 500, if you were trading the quote physical actual cash basket of stocks, you're trading 500 stocks, and at expiration, nobody's going to give you 500 stocks in the right proportions. Rather, the option is settled based on cash. This is a cash settlement, which is, if you trade a lot of products, that's not unusual, but you just need to know that. The early assignment issue. So it's only really a concern if you're short options, because there is rarely any advantage to early exercise. Now, those of you who've traded options, you're thinking, wait a minute. So, okay, what if I buy that $100 call and the stock goes right up to $120, and I might want to exercise my option before the expiration period is up, right? In that situation, the right answer is always to sell the option. Why might what I'm thinking about what might not always be true. Maybe liquidity could be an issue in the options market, and you might want to execute, but rarely is that even an issue. I'll tell you again, here's a theoretical aside. The only time when there's an advantage to early exercise is with a put, when you would be short the stock, and you could there's some interest rate considerations with the money you would take it. So again, highly academic. Just know it's enough for you to walk away from this saying that there's no reason to early exercise your option. So for you as a buyer of options, it doesn't matter if you're trading American or European options, but people do early exercise. It happens. And what will happen is, if you are selling options, and even if you are primarily buying options, a lot of times we spread options, meaning we're buying and selling, and it's not entirely unusual. It's unusual, it's not unheard of by any means. It will happen to you for your counterparty to exercise. And that can have some issues. It can have some issues, particularly in a small account. That can be one of the gotchas, and just be aware of that. Your solution is to talk to your broker about that, know how that will happen, and also to check your positions daily. So switching gears here just a little bit, thinking about two broad ways to trade options. So directional, non-directional. Directional usually means we are spending money. We might be buying and selling options. We might be kind of buying a collection of options. Technically, it's called a spread. But generally speaking, we're probably going to be spending money for a directional trade. And a non-directional trade, usually we have a cash inflow. That's, again, not in all cases, but usually. Directional example. So here's a very simple example. I think a stock which is currently at $80 will go up to at least $100 before the option expires. So how might you trade that? Well, there are a lot of ways you might trade that, but probably the most basic way to do that would be, I think the stock is going to go up, and notice already, like if we were just trading chart patterns, we might say, I think the stock is going to go up, so I'm going to buy the stock, right? That's a logical way to execute the trade. But look what's happened here. I snuck this in on you. Already, options are demanding we be a little bit more precise, because I have to think about when the option expires, and the stock move needs to happen before the option expires, because otherwise there is no point. So simplest way to execute this trade is to buy a call, but a lot of questions. Which strike? Do I buy an $80 strike, or do I buy a $100 strike, or do I buy a $40 strike? Some of those answers are a lot better than others. Which expiration? What will I do if I'm right? I touched on this, right? Will you just coast into expiration? Will you hold it into expiration? Will you sell the option at some specific price target? Here's a plan, for instance, what if you buy two options and you sell one when the price doubles, and then you have the other one for free. That's one possibility. What will you do if you're wrong? Well, you're going to spend a certain amount of money to buy whatever call you decide to buy. Are you going to just let it go to zero? Will you get out when the option goes to some amount? Will you, for instance, if you lose X% of the option premium? I'm not saying these are trading plans, but these are ways you might think about it. So why do I think the stock is going up? It's probably because of a technical pattern, right? Or a fundamental situation. What if that situation changes? Like, what if the pattern breaks? Or what if what I thought was going to happen fundamentally, maybe with a competitor, is not happening? At what point will I step back and get out of the option? So those are all things you need to think about. You need to think about them with any kind of trading. You need to have a trading plan. That's a recurring theme, but you need to have a trading plan that is specific for options. For instance, don't show me your really great pullback trading plan and then say, I'm just going to buy calls instead of trading. That's not enough. It's not enough detail, because you need to think about these kinds of questions. A quick mental trick that I find very useful with options is to think about extreme outcomes. What you're doing is basically kind of going to the limit. So imagine you buy this call and the stock is at $0 tomorrow. It's not what we thought was going to happen, right? What if it's still there at expiration? Or what if it opens up like, some incredible number you can't even imagine, $10,000? What if it's there at expiration? Those are, if you think about pushing things to the limit like that, to extreme situations that are almost impossible. They aren't actually impossible. That, first of all, that's one thing in terms of risk management, but you might trade for your entire life and never see them. They certainly are possible, but it will also show you where some of the hidden tails in terms of risk are. So if I'm doing directional trading, what I'm probably doing is paying money, not necessarily, but I'm getting the right to make a choice in the future. And generally speaking, with these extremes, big positive outcomes, depending how you structure the trade, can just be like it rains money. It's a huge surprise. There are other ways you can structure the trade that it might not be such a huge windfall. And we're going to get into that when we start talking about vertical spreads, for instance. Big negative outcomes, we mostly don't care. If you buy that stock, not an option. Let's say you buy the underlying stock at $80 and it goes to zero the next day, you're pretty unhappy, right? That's a huge loss, and it might be an account ending loss. But with the option, you spend a few dollars, you bought the call, and the call basically goes to zero. You kind of don't care. You'd care if it happened all the time, but in terms of one outcome, you kind of don't care. So that is the kind of the intuition behind a simple directional strategy, thinking about both the positive and negative extremes. If you are already an experienced options trader, then think about your strategies in that light. As you learn about option strategies, think about them through that lens. Non-directional trading, so it's a little bit more complex. We can't, until we really understand pricing, we can't really understand it. But the general idea here is that that person buying the option paid me something for the right to make that decision in the future. Like if I'm the guy selling the car on Craigslist, it's probably not a great place to sell a car. I don't know. The buyer gave me a few $100s, and I'm going to wait to sell the car to somebody else. So he gave me a few $100s so he can make that decision in the future, right? We might be willing to make that decision to sell that option if the price is right and if we think we have a reason for doing so. So how might we trade this theoretical $80 stock directionally? And again, we're getting a little ahead of ourselves, but we could sell a call and sell a put. So then what we would have, which for my risk management style of trading, that's a little frightening. But what you basically have is unlimited risk on both sides. Now, again, I said unlimited risk, but the stock theoretically could go to infinity to the upside, right? So that is actually theoretically infinite. Of course, it can only go to zero. So that's not technically infinite, but in our language and mental thinking, it's effectively infinite. I'll think about it like that. So why would I be willing to take that risk? Why would I be willing to lose an infinite amount of money in either direction? Well, the only reason that I would do that is if I thought the buyer was overpaying for that option. Think about that for a minute. For me to take on that unlimited risk, I have to think that I'm being fairly compensated for it. And in fact, if what I said at the beginning is true, and traders aren't stupid, the market is competitive, things are pretty fairly priced, then right away, this is one of the lies, I think. People will tell you options are always overpriced, and you should always you should always sell options because options are just always overpriced. End of story. It's not true. If that were true, then yes, it would make sense to do nothing but go in and sell options day in and day out. And one of the other things people will tell you is it's like selling insurance. And you can imagine some marketing video here, right? That would show you a gigantic corporate headquarters for an insurance company and thousands of employees and say, well, they got here by selling insurance. You can do the same thing in the options market. No, you can't. It's not the same thing. One of the, why not? Well, for one reason, an insurance company can make pretty accurate predictions about what's going to happen to people. Not any one person, but in a group of people. How many people are going to have car wrecks? How many people are going to get some horrible disease? At what age are people going to die? Insurance companies can dial those predictions in with a fair degree of reliability. Yes, occasionally things happen. Insurance companies get hit. There are some surprises, but there really aren't that many nasty surprises. The market is very good at giving us nasty surprises. Just to throw it out there, there are things that people like to say, oh, this should only happen once in every 10,000 years. Well, that's because they don't understand math. Anybody saying that, they don't understand distributions. But the point's valid that we have some really huge, extreme outcomes. In stock indexes in the US in 2018, we had a handful of very extreme outcomes that really you reasonably would not have expected, unless you kind of flip it around and counterintuitively know to expect the unexpected in market. So the degree of predictability, I think, is quite different. And the other thing that all of these people, anybody trying to sell you things, this is trying to sell you selling insurance options plan, insurance companies do not make money selling insurance. Do you realize this? Pretty much every dollar they take in insurance premium, they pay out in claims. Insurance companies make their money by taking in money and then invest in it. And that's where the insurance companies actually make their money. It's not exactly dollar in, dollar out, but it's pretty close. And that's not, okay, so if selling options is like the selling insurance, that's not a viable strategy for your trading account. And that's not how you, as an individual investor, are going to make a lot of money. I suppose you could have some crazy plan to sell a lot of options, then go buy bonds with the option premium. Like, I don't know, no, I can't imagine that working. So again, we're getting a little ahead of ourselves here, but the point is, for you to sell options, you have to have an edge. You have to have a reason for thinking that little bit extra you're taking in, that effectively the few $100s the guy paid for the car option, there has to be a reason it makes sense for me to take the other side of that trade. And there are reasons why you might want to do that, but it's not as simple as options are overpriced, people pay too much for options, selling options is like insurance. That's one of the lies of the trading education industry, and it's absolutely a lie. If you do non-directional trading, you need to be aware also, you don't really have to have unlimited risk. For instance, it's possible that situation where I described having unlimited risk to either direction, I could at some point say I want my risk to stop here. And for those of you who know a little bit about options, I would sell the put and the call, and then I would buy wings would be the language. But it would kind of be the same thing. Like maybe you start your at-home insurance company, and then you buy insurance to cover your potential losses. It might be one way to do it, but if you're going to do that, think about what's going to happen. You're no longer just taking money from people and then paying out in claims. You now have another expense, right? You're paying for that insurance that you were buying, and that cost is usually pretty significant. What a lot of people find is when you think about structuring those non-directional trades that have defined risk, not always, but all of a sudden, the outcome can be a lot less attractive. Best case for you, going back to, or for me, having sold the put and the call, the best case is the stock goes absolutely nowhere, and both the people who bought those options from me lose money. That's really what you want. You run away with all the money, but let's stretch this and think about extremes. So what is the best thing that can happen? Best thing that can happen is just as I said, in the non-directional case, nothing happens at all. Compare that to, for the option buyer, the best case is they win the lottery. That $80 stock goes to $10,000 and they make a boatload of money. Of course, that's my worst case, right? If I'm the seller, then the worst case is that $80 stock goes to 10,000 and I sold the call, and I'm on the hook for all of that. This guy who made the money doing it, we didn't just create the money out of the air. I'm on the other side of the trade. Worst case for the directional trader is big move against, but it doesn't even have to be that bad. Kind of the worst case also for the directional trader is that $80 stock is just a little tiny bit under $80 or at $80, in which case he loses all of the money at expiration. So you don't even necessarily need that big move again. And a little aside here, I have had a few cases where I've been absolutely spectacularly wrong on the trade and didn't really lose money on the trade because the volatility increased in the option, but we're 2 modules ahead there. So yeah, we covered this. While I think there are so many things that people are telling you that is not exactly true. Selling options, non-directional trading, writing options, it is not the only way to trade options. Is it the best way? Maybe you can decide it's the best way for you, but it's certainly not the best way, the only way to trade options. One of the other lies, you can make steady income doing this. You could do that if the lies were true. You could do that if options were always overpriced, but if options are fairly priced, then any money you make, you're taking on corresponding risk. And it's not at all the same as when I started trading, I thought trading would be like an ATM machine. Like I'd figure out the market and I just go take money out of the market every day. And well, it works like that sometimes. It seems like that sometimes, but it's not really what you're doing. It's not the way it works in the long run. Also, one of the other, and we don't spend a lot of time on this, but people will tell you 95 and whatever number, you hear different ranges of numbers, 95% of options expire worthless. The number is actually somewhere between 75 and 80%, at least is what the CME found with a study. But even that is not nearly as bad as it seems, because you play with the open interest in different ways. It's not exactly accurate, and it's irrelevant, because if you think about the options that are very, very, very far away from the money, that $80 stock, there might be $200 options with $200 strike price listed, but nobody realistically thinks the stock is going to be above $200, and that's not why you trade those. It's not why those are listed. So a lot of the options chain people expect to expire worthless. So it's not really such a point. So options, why, here we're kind of back to why options. Options give you options. There's a nice little line, right? You get to decide how you want to trade, what risk you want to take, what leverage you'll take, how you'll manage trades, how you'll structure trades. All of these things you get to do as part of your trading plan, but to do them, you need to understand. You need to have a full understanding of the instrument, and that's what we're doing. That's what this course is about. I also think one of the other common, when I think about teaching something, I think about the way it can go wrong. And one of the ways that it can go wrong is for you to get a favorite option strategy and then try to apply it everywhere. That's a pretty common way to learn options. So let's say you might learn butterflies, or you might learn vertical spreads, for instance. You might learn debit spreads. And then you go out and you find situations to apply that. Well, paradoxically, you might end up back there. Like I would say the vast majority of options trades I do are one or two very simple structures. But I think for your understanding of the topic, you need to not think in terms, and there are books of strategies, right? There's some good books of strategies, but that's not how you want to learn options. It's not how you want to structure your thinking. So stick with me when we go through pricing and volatility. I think it'll start to make sense. Like I said, you probably will end up with a fairly defined and simple set of tools that you use, but you want to do that from a position of understanding. So here, I'm going to kind of give the outline of the rest of the course, and I will do some Q&A, but I will ask you, I want to be a little bit selective in the Q&A, kind of stick to the topic. So if you ask something that will be, that we'll get to down the road, or that's massively off topic, I reserve the right to not answer that. But if you have a question, type it in the question box. I will ignore the questions here for just a little bit while I go through the outline, but go ahead and type your questions right now. Okay, so overview of the course, giving you tools you can use, thinking about really how the risk and opportunity go together, and focusing on finding that right degree of going deep without getting lost in the details. That's really what I hope to accomplish. Here are the modules. So we're going to talk next week, and maybe next week or maybe 2 weeks. It's also in terms of schedule. We're going to be releasing no more than 2 weeks between modules, and some of them will come out every week. So we'll see. We're going to spend an entire module talking about option pricing. And I know that's not an exciting topic, but it's extremely important, and well, actually, I think it's an exciting topic. It's one of the most exciting modules in the course for me, and let me see if I can make it a little bit more exciting for you. It's not, and I promise you, it's not a math class. I will show you a horrifying equation once in the entire module, and then we'll never come back to it. Really, it's about intuition. It's about understanding how the options price moves when other things move and change. Volatility, that's incredibly important. And honestly, I've spent a lot of my life thinking about volatility. I've spent a lot of my research and coding work looking at and trying to understand volatility. And on one hand, it's a pretty abstract, advanced thing, but it also is very important for options traders. I think it's more important for directional traders than people realize. Then we will look at basic directional strategies, which you'll understand a little bit better. We'll come back to this example of simply buying a call, buying a put. And I will show you in this module my bread and butter trades, the trades that I do, which I'll tell you now are pretty much buying puts and calls and doing put and call verticals. That's most of the trading that I do. And that really would fit on a single piece of paper, but you need to, there's some gotchas. Like, it's not at all uncommon to buy a vertical spread and see the stock make a big move in the direction you thought, and you don't really make that much money. You need to know why you need to expect that. We're also going to talk quite a bit about some of the Greeks, but this is, just trust me on that. Will help you understand positions, help you understand risk a lot better. And then we're going to go back and look at some basic positions, which we probably will do in real time as the course develops, and see what we could have understood. Like, for instance, that vertical spread, it did not, where I was surprised how little I made, I shouldn't have been surprised. And if I understood the position better, I would not have been surprised. And if I understood my Greeks, I would have understood the position better. So that's the whole point of that. Later on, we're going to talk about some more people think about spreads as being really exotic and advanced, and it's not. It's simply a logical outcome, and there are really good reasons for trading spreads. Let me say it again, there are some really, really good reasons for trading spreads, particularly with the skew in stocks. We're going to talk about stuff like that. We will spend a module looking at selling options, both directional and non-directional, risks and potential ways to manage those risks. And then we're going to look at some kind of far out there strategies and grab a module. Some of these are trades that you will apply. One of the strategies that I trade is a type of ratio spread. Terminology is a problem. It's a back spread, but that means different things to different people. But basically, it's a trade that if the market goes against you, you don't lose money, or you may even make a little money. And if the market goes in your direction, you make a lot of money, and you lose some money if the market doesn't go anywhere. There, I'll show you ways to set up things like that, and then we'll have a whole module. Practical examples and thinking about how to tie all of this into your trading plan. So what do you need to do? Well, pay attention, absorb information, be a sponge. Especially at the beginning, read and research, read other books. In no way do I want to tell you I have all of the answers. I absolutely do not. What I think I do bring is a different perspective than a lot of people do. I hope that I do a pretty good job communicating and tying these things together, but you should be reading books. You should be getting all the information your broker has on trading options. You should be reading the information at the exchange. The exchanges have some courses, which are, some of them are quite good. So be an option sponge, not just with my stuff, but with other stuff out there too, and think critically, right? Some of these other things that I've been very critical of, now go back and maybe listen to somebody telling you about selling options is like insurance, and maybe you'll think about that in a different way. And maybe I'm wrong about some things too. It absolutely happens. So you be very critical and think too. It's a critical part of learning, right? And when we do get into market examples, spend some time playing with the data and looking at trades. It's not enough. This is not an academic thing. This is not where I show you some theoretical pricing model and then we figure out the secret to making money with options. This is very applied, very practical. We need to look at how the market is pricing these things and how these things change in the market. So if you will really be, you'll be hurting yourself if you don't spend a lot of time looking at actual market data. And I'll talk about how to do that. I'll help you with that too. So where do you get more information? Well, as I said, you should be following me on Twitter at Adam H. Grimes. You also should do, and many of you already know, my free trading course at marketlifetrading.com. And look, I'll just say, I don't say this everywhere, but I'll say this here. You can spend tens of thousands of dollars on courses and not get the education you'll get from that free course. That is specifically why I created the course. And I know a lot of times you hear free and you think, well, it's it's a trick. There's some trick, or it's not that good because it's free. But I promise you, it's not true here. So if you have not seen the course, go do the trading course, and you don't need to do that before you do the options course. Do them side by side. You also, I'd love to have you check out my website, marketlifetrading.com. I do have a couple premium services there, and this is very, very important for those 40 plus of you who are still here at the end of the presentation. We're going to give away a free month of Market Life to somebody. And the way you will be entered into that random drawing, and it will be random, I promise you, it will be, I have a really cool random number generator, which you might imagine. So it's kind of weird what excites me, isn't it? So there's going to be a survey. You need to fill out the survey. You have two chances. You get the survey when I end the presentation, and the survey will also be emailed to you. So fill out that survey. Your email address will be entered in the drawing, and we're going to give a free month to somebody. If you're already a client, you get a free month. If you aren't a client, you get a free month. So that is the end of our presentation. Now we have some Q&A. Let's see what we have here. And if you have more questions, go ahead and get them in. So let's see. Need to expand the question. There we go. Are the rest of the modules within Market Life Premium subscription? at least the first few modules, and I don't know what that number is, we're thinking 3 probably, will be available publicly. So there'll be public webinars like this, they'll be on the YouTube channel, anybody will be able to get to them. Eventually, the rest of the course will live with Market Life Premium and Market Life Plus, which is, Plus is very fairly priced, but having access to these courses and to the other courses we create is going to be part of the Market Life Plus subscription. So the answer to your question, Phil, is a little bit of yes and no. Thomas asked if the webinar will be available to subscribers. There you go. Yes, subscribers and non-subscribers. Everybody gets this. Peter says, looking forward to basic directional strategies and related examples. Me too. I'm looking forward to teaching that. And I do think that one of the things that is a little bit different about my perspective, and particularly my perspective on options, is the heavy focus on directional trading. If you want to trade options non-directionally, I want to give you the tools to do that, but I also really want to show you ways that you can probably do what you're doing even better with options. Let's just say that. Tim says, thank you, you're welcome, and thank you. First of all, to all of you, thank you. I really appreciate your time and attention. You giving me this chunk of your time is a precious thing. It's the most important thing we have in the world, I think, is time. Several other questions about being recorded, which we answered. Do I use market maker expected move in my options trading? Well, I touch on the course. You've capitalized that. Micah, send me an email. I think I understand what you're asking, which is, are you looking at, based on the price of the option, how much you expect the option to move over the lifetime of the option? And that's certainly a concept we're going to talk about. But the short answer, really, I think the best answer I can give you is no. And it's also why the answer is tied into why we aren't going to spend time trying to figure out a better options pricing model. That's one of the ways people go wrong, is you think, oh, if I could figure out some better options pricing model, then I could make a lot of money. It doesn't really work like that, because the way these things are priced off of supply and demand takes primacy, I guess, or priority over whatever theoretical value there might be. So we'll talk a little bit about that if I understand what you're asking correctly, but it's not something we focus on. You're going to get the slides or some written notes. We will make the slides available for download. Tom, make a note for that, please. On average, how long do I hold an option trade? Well, it's been, over the course of my career, I've traded lots of different ways. The one thing that I have not done a lot of is I have not done a lot of intraday options trading. So I've not done a lot of day trading with options, but I've held options trades for days, weeks, and in some cases, months. I think my longest options trade, I did some things with some leaps a while back, which, in the process of experimenting and learning, you learn things that don't really work with your personality, and that time frame really didn't. But a better question is how long you are going to hold, and that's really a question of your trading style. My personal answer to that, I don't think, is incredibly relevant to you. Let's see, what proportion of my trades are executed with options? Well, again, my personal answer has been all over the place. There have been periods of where my trading has been 100% options, and then there have been periods where I have done very little, or I've done no options. So I have, to give you an answer to that, I think it's far more relevant that you think about how much of your trading eventually will be with options, and the more you learn, the better you can answer that question. Let's see, more questions about recorded. So I think we answered that. Okay, so just reading through some of these. Is it a good idea to use the Taylor market timing style as a way to trade options? I've never really been able to make that work in any systemized fashion. The Taylor rhythm is basically the idea that markets reverse on a day-to-day basis. I'm horrifically oversimplifying. You could do that with options. and in fact, a lot of the short-term mean reversion strategies that quant firms trade, particularly in the indexes, are based on a similar idea. Could you execute that with options? I think so. Would I? Probably. I personally probably wouldn't, but you certainly could. Let's see. My book on technical analysis is one of the best. Thank you. Am I going to write a book on options too? I'm going to write another book. I don't know when, and I don't know. There's several books that I want to write, but it's a horrific undertaking. I'll just tell you, writing a book is it's a monster of a mountain to climb. So I will write another book. I don't know when, not this week at least. But thank you for your kind words on my book. Certainly appreciate it. Am I going to specifically address how to incorporate options into swing trading, position sizing? Yes, absolutely. When to choose options on stocks? How many options positions? Yes. Futures or options better for directional plays on indexes or commodities? Yes. Again, that's a question that one is again, it depends how you're trading, and you could make an argument for one being better than the other, but for your specific situation, one is probably going to be better than the other. I'm going to give you the tools to answer that for you. But it would depend on your financing situation. It would depend on how you get in and trades, out of trades, all of those things. Somebody says, is there an advantage to trading pullbacks with options? So we're getting a little bit ahead ahead here. But yes, you've hit on one of the key questions, which is, so trading pullbacks, let's see if I can still draw on the screen. If you have a market that goes up and then makes a pullback, if we're trading directionally, we can wait for this turn and we can use the confirmation. So you have that eternal trade-off between trade location and confirmation, meaning if I wait for confirmation, I've already given up some trade location. But if I don't wait for the confirmation, where do I buy? In the theoretical book example, you buy here, but I can guarantee you'll buy here, you'll buy here. You'll be early and wrong a lot. So your question, correctly, you're noticing that if you buy into this pullback with options, you don't wait for the confirmation, because it's a little bit more difficult to wait for the confirmation. If you're going to wait for the confirmation, maybe you'd use verticals. I'm assuming since you asked the question, you know what I'm talking about. You might buy, you might look to buy calls in the pullback, which can make sense because the implieds are contracting. And yes, you're going to lose on a certain percentage of those trades, dramatically on a certain percentage of them. You're definitely paying time decay, all kinds of reasons why that might not make sense, but the contraction of the implied might, and I'm way ahead of us here, I know, but I'm assuming you asked the question. This is the kind of questions I wasn't going to answer, but I am. But one possibility might be to wait for the confirmation and then to do a vertical, which will mitigate the ballooning of the implieds. So sorry about that. Let's see. Plans to provide a modified trading plan, gives a basic what to look for in options trades. I have a plan to provide you with the tools to make your own trading plan. So how's that for a smart ass answer? I think I got all the questions. There we go. Yeah, I know. Okay, so again, thank you. Appreciate your time today. You will be getting the survey, and just make sure it's the least painful survey I've ever seen. So just please fill that out, and we will give one of you. You know what? We'll give two of you. We'll give 2 free months to Market Life. So go ahead and get in for that, and we'll get that drawing done and get back to the winners here. And keep an eye on my Twitter at adamhgrimes.com, and you can expect the next module within 1 to 2 weeks. Thank you very much.